So what is working capital? We understand working capital is equation wise. If we put it across, it would look like working capital is equal to current assets minus current liabilities. So current assets minus current liabilities when capital is raised. So the last class we were discussing about investment which is raised from various sources of finance, and then tested whether that investment proposal is good or not is what is um, the investment appraisal techniques. We were discussing them, and some more points are there which we have to discuss. So then after these finances are raised, they have to be invested into assets. So broad classification of assets in the balance sheet, we see that there are assets which are invested for a short period of time. Then we have assets which are invested for a long period of time. So broad classification of assets can be classified as current assets and fixed assets. So the time duration is the criteria to decide whether they are current assets or fixed assets. Then the classification, just look into the classification of liabilities. Liabilities, broad classification, there are three different types of liabilities: current liabilities, long term liabilities, and equity. So these are the three categories. So current liabilities is for a short period of time, and then long term liabilities and equity is for a longer period of time. So here the point is, when funds are raised, funds are not kept idle. They are generally invested into some investment proposal, some asset, some project, some proposal. The amounts are invested. They are not kept idle. The reason behind that is, see, cash kept idle does not give any return. We understand that. So because the idle funds do not give any returns, so they are invested into some asset or the other. But yet at the same time, we also see that cash requirement is there all the time, either to make the payment to the liabilities, for the various liabilities the payment has to be made, or to meet day to day transactions, the operating expenses, cash is required. Now there is a balance which is needed in terms of, idle funds do not give returns, therefore profitability has to be looked into, therefore they are invested. Another thing is the liquidity part of it, which is important, wherein they test about what is their position in the short run. On account of a non availability of funds, if payments are not made, that affects the business in terms of its reputation. If they are unable to meet their payments on due date, um, the reputation gets affected. External stakeholders will not be willing to uh, transact with the business in future. So that is again another danger. So there is a balance which is needed in terms of taking care of the profitability as well as the liquidity. Therefore funds are invested for short period of time, wherein at the end of the short period they get converted into cash, and some of the assets are invested for a longer period of time, wherein the it is not possible to convert them into cash, or it is not possible, or uh, it takes great efforts to convert them into cash. So here we see that the funds are invested into short term and long term. So then the short term assets get converted into cash, which will be used to, these current assets are used to meet the current liabilities. And over and above that current liabilities, any amount which is available will be used to meet the day-to-day requirements of the business. So to take care of the working capital requirements, working capital is calculated as how much capital will be available with them after the current liabilities are paid, and the funds are available by converting current assets into cash. So on account of this, we need to understand what is the operating cycle. So operating cycle is a cycle where the amount of cash is invested into the raw material. Raw material is purchased. The raw material gets converted into finished goods. After they get converted into finished goods, the finished goods are to be sold. So if they are cash sales, cash will be received immediately. The cycle goes on. So the cash amount is invested into raw materials. Raw materials get converted into finished goods. Finished goods, when sold on cash basis, cash will be realized. But then most of the time, to increase their sales, or as a part of the credit policy, sales are made on credit basis. So credit basis, then they get converted into receivables. Only at the end of the credit period, the receivables amount will be collected. So it takes a period of time. So material is there in the stores department for some time, and the time duration which it takes for the raw material to get converted into work in process, then finished goods, and after the finished goods are moved to the showroom, then the sales should happen only on demand from the customer. Sales happen, then based on the credit policy, again the period extends. So as long as the operating cycle period is there, okay, that will be taken as the criteria to talk about what is the meaning of current assets. Current assets are those assets which get converted into cash in a period of 1 year or operating cycle, whichever is longer. So during that period, it becomes possible for the current assets to be converted into cash. So whichever is longer is taken as criteria. Why are we saying longer? Some of the industries which are into manufacturing heavy machinery, equipment and all, manufacturing process itself goes more than 1 year. So whichever is longer, either it is 1 year or operating cycle, whichever is longer will be taken as the criteria to define what are current assets. So those assets which can be converted into cash in a period of 1 year or operating cycle, whichever is longer. Same is the case with current liabilities. The period is 1 year or operating cycle, whichever is longer. So depending on the criteria about what are the number of days where this stock is held, cash is held in stock, or the number of days when cash is held in receivables. So these two things are to be added to understand what is the period of operating cycle. But yet at the same time, the way credit facility is given to the customer, suppliers also might be giving the credit facility to the business. So there is a credit period offered by the suppliers, as against which when they take the benefit out of that, their payments can be delayed. So operating cycle can be calculated as days in which the cash is held in inventory, plus the number of days in which the cash is held in receivables, minus the cash delay in terms of making the payment to the creditors, is operating cycle. So after they get converted into cash, the criteria is to meet the current liabilities. Over and above that, anything which is available will be taken for meeting their day-to-day expenses, working capital. So the cash operating cycle in expressed in terms of number of days also can be expressed as inventory days plus receivables days minus the payables days. So inventory days plus receivable days minus payable days talks about the operating cycle, cash operating cycle. How can they improve the cash operating cycle? So the formula says that the number of days where the cash is held in inventory plus cash is held in receivables minus the payables day. So here it says, the next slide talks about how can you reduce the operating cycle. So as long as the cycle period extends, it is a problem for the business. Why is it a problem for the business? Because funds are raised, already we've discussed, funds are raised from various sources: debt capital, equity capital, that is ordinary shares, preference shares, or short term loans, or some loans from bank or financial institutions. So multiple sources are available where finances can be raised. On all these sources of finance, where finance is raised, cost of capital has to be paid. So they have to pay interest if it is debt capital, if they have to pay dividend if it is equity capital. So the amounts which are raised are invested. So the investment amount should be converted into cash. So, and only when it is converted into cash, they would have some cash available with them to meet the payments of apart from all the other things, they also will have cash to make the payment of interest, dividend, etc. So for that reason, availability of cash is important. For that reason, operating cycle should be reduced. If it is for a longer period of time, then when the funds are raised from external sources, during that period, they would be making the cost of capital. They would be paying the cost of capital on the capital which is invested into the operating cycle. The longer the operating cycle, higher would be the finance cost. So let's say that they have raised a bank loan to be invested in operating cycle. So the amount of loan which is taken and invested, now the cycle goes on. So the cash amount which is invested then gets converted. So let's say that initially it takes only 2 months. So for 2 months amount is blocked, so they would pay interest on the bank loan for 2 months. But because they are extending this period by offering credit facility to the customer, it gets further expanded. So from 2 it can go up to 3 months. So one more month if it is added, then their cost of finance, the cost of capital will increase by one more month. So as many number of days of the operating cycle increase, cost of capital also increase um, proportionately. So for that reason, the concept says that reduce the operating cycle. What are the ways in which the operating cycle can be reduced? So when we look into that, what are the ways in which the operating cycle can be reduced is quickly convert the inventory into um, finished goods. So put every effort to ensure that there is efficiency in production, so their raw material gets converted into finished goods, and after they get converted into finished goods, effort should be put in to sell them as quickly as possible. So only when sales happen, there is a possibility of earning a return, there is a possibility of getting the cash. So the inventory which is invested, the cash which is invested into inventory should be very quickly converted into turnover or sales. So that is how uh, they would be able to reduce the operating cycle period. Okay. If they do not take longer periods of time to convert the raw material, so there here some way they will be able to save the time. So if this is shortened, after that, so why are they selling it on credit basis? This is a strategy to increase sales. This is a strategy to increase sales is fine, but they should also ensure that longer credit period should not be offered to the customers. It should be used only as a strategy to increase their sales, but they cannot block their funds in receivables. So these are the ways in which they can think about reducing their operating cycle. So reduce cycle time by improving production efficiency, improving finished goods and raw material inventory turnover. So everything should be reflected in turnover. They should be able to convert their variables into turnover. Then improving receivable collection and payable payments period. As early as possible, they have to collect the amount from their customers, but delay as much as possible while making the payment to the suppliers. So there's no question of ethics or anything. If there is a credit facility offered by the suppliers, avail that to the optimum extent, but ensure that the customers pay promptly on the due date, or adopt strategies wherein they availing those benefits, they are compelled to pay it as early as possible. Something like if they pay early, they can avail a discount of. These are strategies which can be used. So the point is, as early as shorten um, the operating cycle is, it is better for the company in terms of saving their cost. But otherwise, cost of capital will increase proportionately by the period which gets extended. There are few ratios which we need to look into. See, exclusively they may not be tested here in the examination, because it is tested in these ratios, which are liquidity ratios, are tested in management accounting. Later on they are also tested in performance management. Okay, so the chance that an exclusive case or question comes on working capital ratio, but it can be part of another question. Okay, or MCQs can be tested in terms of what are these ratios. So we have current ratio is equal to current assets by current liabilities. Quick ratio is all the current assets excluding inventory and prepaid expense. Prepaid expenses is also not a quick asset, because out of inventory to get converted into finished goods and then sold, and then uh, getting the cash amount from that is not a quick process. It is a current asset, so a time period of 1 year is considered to decide about which one is a current asset. So on that note, it is a current asset, but very quickly the amount has to be collected. It is not possible out of inventory, because production process itself is a time consuming process. Then the finished goods have to be sold, and then cash has to be received. So it's not a quick asset. Prepaid expense, on the other hand, on account of prepaid expense, benefit can be realized. Okay, benefit can be realized, that is, the services can be used in the next period, but very difficult that cash can be realized out of that. So eliminating these two items, all the other current assets are quick assets. Then we have receivable collection period. So receivables turnover ratio. So first thing is we have to find out what is receivables turnover ratio. So it looks like, let me put it on a Word file. So here we see receivables turnover ratio is calculated. So how quickly is the receivable converted into sales is what is looked into. So we need to understand what is, how quickly can receivables be converted into cash is what is looked into. After that, if we are converting that into period, what is the period when the receivables are collected? So receivables average collection period is calculated as 365 by or 12 months divided by receivables turnover ratio. Similarly is the case with inventory turnover ratio, which is cost of goods sold by inventory. The period will be 365 days or 12 months divided by inventory. Payables turnover ratio, it would be credit purchases by payables, or the period of payment is average payables period is equal to 365 days or 12 months divided by payables turnover ratio. So convert them into number of days. So the slide talks about what is the receivables collection period in days, that is receivables by daily sales or receivables by total sales. So sales by receivables is turnover. So 365 by turnover is, that turnover is reversed. Therefore, we have receivables into 365 by total sales. Then we have payment period, payables into 365 by total purchases. So we get to calculate what are these two variables in terms of number of days. Next one is inventory. Inventory is inventory by cost of sales into 365. So once we understand that, we will be able to calculate what is the working capital, operating cycle period. So the inventory turnover days plus the receivables turnover days minus the payable turnover days. So in terms of number of days, once it gets converted into number of days, when we add them and subtract, that is inventory and um, receivables are added, from that payables are deducted. So we would get what is operating cycle days. Okay. Further, if we expand that and look into how do we calculate these number of days, see, inventory can be taken as raw material in the raw form, in the semi-finished form, which is work in process or work in progress. Then we have inventory in the form of finished goods. So inventory turnover or inventory holding period can be very specifically split into what is the time duration for raw materials, what is the time duration for work in progress, and what is the time duration for the finished goods to get converted into cash. So we have the formula given as stock of raw materials into 365 by raw material usage. Then we have work in progress into 365 by cost of production. Okay. Then for finished goods, stock of finished goods into 365 by cost of sales. Okay. So the inventory turnover ratio, just now we've discussed, it is cost of sales divided by average inventory held. Okay. There are logics behind how we calculate that, but that's already discussed in management accounting. So we just have to move forward. Then how is inventory managed? Managing inventory need to maintain a balance between liquidity and profitability. Sufficient inventory to meet customer needs. So, because we've already discussed that inventory takes a longer period of time to get converted, but if inventory is not available, that is again a problem. See, on account of non-availability of material, if the production process gets affected, if it is stopped, then the overhead cost would be incurred with no benefit, with no production taken up. So if that is the situation, if that is the case, then that is a loss to the business. Therefore, it has to be ensured that sufficient amount of material is all the time available in the stores department. There is no there should be no impact on the production because of non-availability of material. So they decide on what is the maximum requirement of material at any given point of time. So the maximum material is the maximum inventory level which is considered from, on a scale of inventory which is held from 0 to maximum number of units. Okay. See, this is the maximum inventory which is purchased. Now here we are considering a balance to be maintained between, okay, the liquidity aspect of it and the profitability aspect of it. So, in terms of liquidity and profitability, if they invest too much into inventory, it is a problem for them to get it converted into cash. So, liquidity gets affected. If they invest too little in inventory, that again is a problem because only when inventory is available, production can be taken up and then sales can be made. So now how much should be invested into inventory is a criteria. So here let's take the situation where on a scale of inventory, if inventory is invested in from 0 to maximum number of units, anything which is taken up from 0 to maximum number of units. So let's say that if they have um, invested or purchased inventory and stored it up till maximum extent. So now, as the material is issued to the production process, we see the level of inventory keeps decreasing. When they keep decreasing, we see that the inventory levels are coming down. can they afford to wait until the stock levels reaches zero? No, they cannot. Okay, they cannot take a chance and then wait until it touches zero, because once it touches zero, there would be no material available. Already we've discussed that. Because of non-availability of material, production gets affected. Fine. So even before it reaches the zero limit, they have to place an order, because unlike other purchases, this is a time taking procedure to purchase material. Because suppliers have to be selected, orders have to be placed, then they catering to the order, the requirement, material is supplied, then it is checked for the quality, moved to the stores department, placed in the appropriate place. It's a time taking process. So if it is a time taking process, an order has to be placed by them even before the inventory level touches zero. Okay. So during that time, even when the order is placed, they should have some amount of material on hand to meet their requirements, production requirements. So let's say that at this point, when it reaches this point, they think about placing a other order. So that let's take this one to be as reorder point. At this point, another order would be placed. So even after an order is placed, also material is issued to the production department, it keeps reducing. So by the time it reaches the zero limit, before it reaches zero limit, so they, ideally speaking, they should receive it, they should receive the order which is placed, the reorder point. At this point they are placing an order. So after the order is placed, also the material keeps reducing. Ideally speaking, it should, the new order should be received before the inventory level touches zero. So generally there is a safety stock which is decided. So by the time it reaches the safety stock, the new order should be received by the business. So that is the scenario. Okay, if this is the reorder point, at this reorder point, how many units should be ordered? Now that is reorder quantity. So now they have to consider about what is the reorder quantity. So reorder quantity is calculated by way of considering what are the various costs which are needed to be incurred. What are the costs normally when in case of material? In case of material, the material cost, the requirement of material, how many units are required in a year, per annum, how many units of material, quantity of material is one cost. So the quantity of material has to be purchased, so the purchase cost of material has to be taken into consideration. After that, we see that to place an order, to place an order, they have to incur ordering costs. Ordering cost, like someone has to be appointed to look into these matters, to communicate with them, postage, telephone, these things, wherein they are in touch with the suppliers, orders are placed with the suppliers, and catering to the requirement, suppliers supply the material. So there is a procedure for ordering also. So it is not directly moving into, walking into a showroom and then purchasing material. There is a procedure where orders are placed with the supplier. So someone takes care of all these things. After the material is purchased, the material has to be stored. So storage costs are also to be incurred. Storage costs have to be incurred. So storage cost, what does it mean? See, if they purchase a bulk of material, this material has to be properly stored in the stores department. So someone has to take care of this material to store it appropriately, to ensure that there are proper racks and bins and shelves, and measures are taken to see that they do not get spoiled or anything. Taxes which are paid on the material which is purchased, or the rent expense which is paid on account of, I mean, to store this material in a place for the stores department, rent expenses are paid. So all of them which are connected with storing the material add up to the storage costs. So any tax paid, insurance paid, rent paid, uh, and then measures taken to store the material, all of them form a part of the storage cost. So now there should be a balance between what is ordering cost and what is storage cost. See, if they purchase in small quantities, if the requirement is, let's say 20,000 is the requirement. If they are buying as 2,000 in one lot, 10 times they have to place orders. So the ordering cost will be incurred 10 times. So every time they are placing an order worth for. Okay, so if they are placing an order for 2,000 units at a time, so 10 times they would be placing orders. So they are placing orders for 10 different times. So ordering cost will increase 10 times. But if they are placing a bigger quantity, let's say that if they are purchasing quantity in lots of 10,000 units. So 10,000 units, how many times will they purchase? Two times they will purchase. So ordering cost will be less, but to store these 10,000 units of material, the storage cost will increase. Okay, when the storage cost increases, the ordering cost decreases. When the ordering cost increases, storage cost decreases. So a balance between these two types of cost should be there. So for that reason, what is the quantity that is ordered, which is also economic in nature, is what has to be calculated. Economic order quantity. Economic order quantity is given by a formula. EOQ is equal to under root 2 COD by CN. Each textbook has a different variable which is used, so don't have to be worried about what variable. The logic is under root 2 into the total quantity which is needed during 1 year, okay, into O is here. It O talks about the ordering cost. CO is equal to cost per order. Cost per order into the total requirement, the consumption, the demand for material during a year, annual consumption, annual demand, divided by H is denoted for holding the material or storing the material. So divided by CH, that is holding or storing the material. Okay. So the formula is EOQ is equal to under root 2 COD by CH. So there are various variables used in different textbooks like 2CO by I, 2CO by H. So whatever is the variable, the numerator has the annual demand or the annual consumption of material into the cost per order, divided by the denominator has the cost of holding the inventory per unit per year, per unit per year. So when we calculate this, we understand what is the quantity of material which has to be uh, placed, which also proves to be economical in nature. So it is cost saving. So by nature, that would be the ideal quantity which can save their ordering cost as well as their storing cost. So EOQ is the first formula which we are looking into under inventory management. Then, what are the inventory management systems? Um, Conventionally, we see that the conventional way of Purchasing material is purchased even before there is an order placed by the customer. So even when the customers are not there with their order also, based on some anticipation, some forecast of what would be the demand, generally the conventional method of purchasing material is with the supplier. Order is placed. So an order is placed with the supplier, catering to the requirement of the business. An order is placed with the supplier and the material is received by the business. After they receive the business, what do? They put it in the stores department, store it in the stores department. From stores department, the material is moved to stores, and then it is moved to production. So production is taken up. After the production is taken up, that is again moved to the warehouses or showroom. And finally they are kept available for the customers to come and purchase. So then they are available for the customer places an order for these things and then he purchases. That's the conventional way of purchasing. But JIT says that, see, as long as that cycle is there, for that long period they are paying cost of capital, they are incurring storage charges. So because it is all based on an anticipation and storing, piling up the material, producing the products, and then keeping it available, all these things, the JIT system feels are unnecessary. Why to incur the cost? Why to spend amount on material even when there is any demand? So the JIT system works in a reverse fashion. So first, the business waits until an order is placed by the customer. So they wait for the customer to place an order. So customer places an order with the business. On receiving the order, production is taken up. But to produce that, where is the material? Material is not purchased. So to meet this production requirement, material has to be purchased. So purchases take place. So they pre-decide on select the terms and conditions with the supplier based on the requirement to purchase the material. Supplier then supplies the material. So it works in a reverse fashion, reverse style. This works. So that's the JIT system. So what is happening when they take up the production right at the time? Then to meet the production requirement, they're purchasing material right at the time. So immediately they purchase it from the suppliers, convert the raw material into finished goods, and sell these finished goods to the customer. So there is no time period wherein the cash is blocked in the inventory or any other asset. So everything done gets completed instantly, quickly, and then they don't have to invest amount into any type of investment and pay cost of capital. So that is the advantage of JIT system. So it aims at elimination of inventory, finished goods made to order. Only first the order has to be received. Only on receiving the order, the production will be taken up, and to produce the products, material has to be purchased. So to purchase it, the supplier is pre-selected. The supplier is pre-selected, who's also a reliable supplier, and without fail he delivers the material, so they would not face any difficulty in terms of the supply of material. Then there are other features also along associated with JIT, that is workers in the JIT system are multi-talented, multi-skilled workers. So they can replace anyone at any given point of time on account of anybody's absence. Also, work will not be disturbed. It will be smoothly carried out, and the order will be completed and delivered to the customer. So, in the first, the traditional method, they need to manage this inventory, store it in the stores department, and periodically verify how much material is consumed, and what is the balance available and all. But in case of just in time, they do not have to put in any effort to store the material, because everything is taken up just in time, right at the time. So they don't have to worry about or focus on storing the material. Storing the material in the stores department is not needed under JIT.
Excuse me, ma'am.
Yes. Yes.
Can you please tell me what does elimination of inventory means once again?
The traditional method, what are they doing? They're purchasing even before there is an order. They're purchasing material. This material is the material is received by the supplier, stored in the stores department. So inventory is there in the stores. Okay.
Yes,
Then
ma'am.
they take up the production, move it. But in case of JIT system, they don't buy anything. They don't buy material. They don't have a stores department where they store it. They wait until a time when there is an order received from the customer. So on receiving the order from a customer, then they look for purchasing the material. So but then purchasing is a time taking process, is just now we've discussed. So
Yes,
for
ma'am.
that reason, they pre-select the suppliers, and who happen to be reliable ones, as and whenever they require material, they are readily available to provide quality material at the price which is pre-agreed upon. So now they don't have to have a stores department, they don't have to store the inventory, so aims for elimination of inventory.
Ma'am,
That
but this JIT system must have some flaws, right?
uh, if at all, if the supplier doesn't supply,
Yes, ma'am.
then stock out, then they would not be able to complete their order. And I mean, it looks very attractive that they don't have to store any inventory and all. They are cutting down on their cost. That part is fine, attractive, but no matter, even if he is reliable also, what if he fails? If he fails, then order will not be completed. That affects their reputation, that affects the demand for future as well, because customers, once they don't trust the business, they will find another alternative. That is one thing. Any kind of a machine breakdown or anything in the production process. So technically, the assumptions are that the workers are multi-talented. They arrange the inventory in such a way that it takes less time. Those points are all very nice, but anything which happens with the production, customers will not be provided with the finished products. So that is again the danger. The danger is there in case of JIT. But unless until some problem arises, until then, uh, it looks much attractive than the traditional method. Next comes the accounts receivable. When goods are sold on credit basis, more number of customers get attracted. So sales increase. To increase sales, the strategy which is adopted is selling goods on credit basis. That's the strategy which is adopted. Now then, how are the accounts receivable managed? So first thing, the business should have a credit policy in place. So based on the credit policy, then they sell their products on credit policy for extending a credit period for some number of days or weeks or months. Right. But how does it happen? So is credit facility extended to all types of customers? That is an important point. Or are all customers entitled to that? Then they have to evaluate what is the credit worthiness of the customer. Can credit facility be extended to any individual customer or customers? Is verified by looking into the credit worthiness of the customers. Assess the credit worthiness. Then have controls on credit limits. How much credit facility can be extended to a customer? So that is control credit limits. Then we see promptly invoice these transactions and collect any overdue debts. Then follow-up procedures. Follow-up procedures is reviewing their procedure of extending credit to the customers, then monitoring the credit system and monitoring the credit system for it is whether it is properly functioning. So have the procedure once again look into these things and whether it is properly working. And see, credit facility is given to increase the sales, but this credit policy is causing some problem to the business about its liquidity aspects. Funds would be blocked in accounts receivable. So as long as the credit period is there, they will be um, having a problem in terms of meeting their liquidity requirements. So funds will not be available. So they will not be able to make the payment to their current liabilities and meet their operating expenses. What is the alternative? They have to approach other sources of finance and raise finance. Additional finances have to be raised. Okay. So to meet this problem, this situation, what alternative do they have? The alternative what they have is they can go see if they raise funds from outside market also they will have to pay interest on these additional funds because funds are needed to meet their liquidity requirements to make the payments to various parties they need funds. So instead of borrowing from outside source, they can give an offer to the existing customers that if the payment is made within a stipulated period, then they can avail a discount of some percentage. Okay. Let's say that the credit period is given for 30 days. The total duration of credit period is extended for 30 days. Now, for 30 days, they will be uh, troubled on account of non-availability of cash. So during this 30 days period, if they want to collect the amount from the customers, they go in for announcing a discount facility. Let's say that the total credit period is extended is for 30 days. So it would be mentioned as um, n divided by 30. But it also says that if you pay within 15 days, a percentage of discount will be offered to the customers if they pay within a stipulated period. So 1 week, 10 days, 15 days, something like that will be mentioned that if you want to avail a discount facility, you pay the amount within a defined period of time. So that way, uh, first the credit period extended is a part of the strategy to increase their sales. Next one is to meet their liquidity requirements. They are also offering a discount. So these two strategies have to be adopted to ensure their profitability plus their liquidity. There is a formula which is given for calculating what is the cost of discount, effective cost of discount, annual cost of discount. See, the previous example what we have looked into, if they pay within 15 days, a discount of 2% will be given. So for a period of 15 days, if it is given as 2%, that effective cost of discount when it is converted into 1 year or per annum basis. Sorry about that. What is the discount? Annual cost of discount is equal to, there is a formula given, 1 plus discount by amount left to pay. So if they are given a discount of 2%, 2% 0.02 divided by, they will have to pay 98% of the amount. So divided by 0.98 whole to the power of how many periods are there during that year. So the number of periods in a year is what has to be calculated. That is to the exponential power, and the whole fraction minus 1 gives us what is effective cost of discount or annual cost of discount. So some other time we'll take up a numerical question and look into how do we solve this numerical question. So monetary cost of discounts offered. So monetary cost of discounts offered. Any loss of cash received from customers, then monetary benefits of discounts offered, reduced receivables balance leads to lower receivables funding costs. Funding cost is calculated as average receivables into the interest rate which is paid on the funds which are raised. So that's the funding cost. We're discussing about giving a cash discount to the customers, but there are certain other services also which are available in terms of receivables. So we see invoice discounting facility, then we see factoring services. So these two things, let's discuss these two things. Just a second, 1 second. See, when a sale is made, when a credit sale is made, we see that the company is selling goods to the customer. So, as against the sale, invoice is received from the customer. So, when the invoice is presented on the due date after the credit period expires, when the invoice is presented, as against the invoice, amount has to be paid by the customer. The buyer has to pay the amount, or the seller will collect the amount from the buyer. Okay, but during the credit period there is a problem in terms of liquidity. That is what we've discussed. So to meet the liquidity requirements, what they can do is they can borrow funds, or there is another financial service which is available, which is called as invoicing the using this invoice and discounting this invoice with a discounter. Generally we see that it's a bank or a financial institution. So what do they do? They as against the invoice, so the invoice which is collected from the customer is given to the invoice discounter against, because that's a proof that they have an asset which can be used to collect the amount at the end of the credit period. So there is a kind of a claim which they can make against this particular asset. So on presenting the invoice, amount is paid to the company by the invoice discounter, usually a bank or someone who's into providing finances. It says that the company borrows up to 80% of the value of the debt. So if the invoice is worth 1 lakh, at least 80% of that will be collected from the invoice discounter at the end of the credit period. So what does the company do at the end of the credit period? The company will collect the amount from the customer and remits the balance to the remits the amount to the invoice discounter. So the company pays the invoice discounter the amount borrowed plus adding some amount of interest. Okay, so the invoice discounter is also assured that the amount will be paid by the company, because there is a proof that the customers would pay some amount at the end of the credit period. So as against the invoice, a discounter provides a discounted amount for the credit period, and at the end of the credit period he receives back his amount, usually up to 80%, plus whatever is the interest which is due on that amount. Calculating that added to the due amount, the total amount will be paid back to the invoice discounter. Something similar on these lines, we have another financial service which is called as factoring. In case of factoring service, company after sells the goods to the customer, the invoices are sent to the factor. So now factor is a third party who's present there. So as and when sales happen, because sales do not happen only at one particular point of time, they happen continuously. So every single day sales happen. So as and when sales happen, when they sell goods, so these invoices are collected from the customer and they are sent to the factor. Like the invoice discounter, factor also gives a particular percentage of amount to the company on the due date. Okay, on the due date, the factor will collect, presents these invoices to the customer and collects the amount from the customer. Earlier case, it was the company which was collecting the amount from the customer, but here factor collects the amount from the customer and remits the remaining amount of the balance amount of the sale transaction. So if it was only 80% which was remitted first time, now the balance of 20% amount will be paid to the company after deducting any charges or any interest amount. So those things are deducted. The rest of it will be remitted to the company by the factor. Factor is a third party who's there between the company and the customer. What if in case bad debts arise? So who will have to bear that? So there are types of factoring, that is factoring with recourse, without recourse. If it is with recourse, the responsibility will have to be borne by the company. But if it is without recourse, in that case, there is no recourse, there is no taking back of the responsibility by the company. Without recourse, the factor only will bear the bad debt loss. So here there are certain charges which are charged by the factor. So in case if it is without recourse, his charges will be higher than the regular ones. So that is one feature. By debt factoring, the company is benefited. The company is benefited because uh, it has decided on taking up a credit policy, selling goods on credit to the customers. That's all fine. Then they would be able to say increase their sales by selling it on credit basis. That's first advantage. Second advantage is they can also meet their liquidity requirements because there is a third party called as factor present there. As and when the invoices are presented, at least a percentage of the amount is received by the from the factor. So they can also meet their liquidity requirements. They can increase their sales, meet their liquidity requirements. So it's beneficial for the company, beneficial for the customer also because they get to pay it little later. So they can avail a credit facility. Factor also it is he is also benefited because as against the amounts which are remitted to the company on that for that particular period, some interest can be collected or some charges can be levied on the company. So after deducting those charges, the balance of the amount will be remitted. So factor also get to earn some income on this factoring service. So here it is administration and debt collection only. Here debt collection and administration with financing. Okay, the factor pays the company the balance less an administration fee and financing fee. That is cost of interest. So that is also paid. Is that clear? Is that clear?
Yes,
Yes,
ma'am.
ma'am. Okay. Ma'am is here, no? Did you speak to ma'am?
I've texted. I think she's in the call.
The next one is accounts payable. Accounts payable is um, what is accounts payable? When material is purchased from the supplier is extending a credit facility. On account of availing that credit facility, a liability is arising. Liability to pay the supplier at the end of the credit period. That is a liability. And usually this is for a short period of time. So that's why this is categorized as current liability, a period of 1 year or operating cycle, whichever is longer. So that is the meaning of current liability. And it is most easiest and simple and convenient form of availing a credit facility. So as and when they purchase material from the supplier, they can avail this credit facility. Okay. Normally it is seen as free. So when credit facilities are provided to the customers or by the suppliers, there are no interest charges which are levied on that. So normally seen as free, but supplier may offer a discount for prompt payment. Okay, so that becomes a benefit there. Then cost is equal to quicker payment leads to lower payables balance, which leads to increased need for other funding. So whenever the supplier is giving a discount facility, a benefit can be availed, but then again they will be tied up with the availability of funds. If they make the payment, then availing that discount facility, if they pay it immediately to avail that discount, they will not have sufficient funds to meet the other payments. That's a problem. So minus the benefits is equal to less cash paid, less amount of cash paid to the suppliers. Undue delays in payment can result if they do not meet the payments on due date. Then the reputation, loss of reputation and goodwill. In future, supplier may refuse to supply material, so that again is a problem. And then henceforth, the supplier will start charging a higher price for the material because he does not trust. So because there are failures on part of the company in terms of making the payment, so henceforth the supplier will start charging higher prices because of their failure to make the payment on due dates. Next one is next current asset is cash management. Um, at the beginning of this class, we've discussed that cash is not kept idle in the company, in the business. Idle, it is not kept idle, it is invested. But yet at the same time, we've also discussed that sufficient amount of cash has to be present or available to meet their payments. So there is a strategy of investing into short term assets which get converted into cash, and using this cash they can meet their liabilities and other expenses. So that is the strategy. So why is cash needed has to be first understood. Cash is needed for various reasons. To transact, to meet the transactions, day to day transactions, cash is needed. Then as a precautionary measure, cash is needed. As a speculative motive also, cash is needed, that in future some discount facility can come up or something offered by the suppliers can be there, wherein if they purchase in bulk quantity, they can avail a discount. So certain things, if they are speculating would happen in future, to meet those things cash is needed. So cash is needed to be maintained, some amount is needed to be maintained, and the rest of it has to be invested. So there is a management needed to understand how much cash is required and how much cash should be maintained. So that's cash management. So there is a model which is given by Baumol. So there are two models with respect to cash management we are going to look into. One is Baumel's model and another one is Miller ORR model. So Baumel's model is similar to just now we've learned about EvoQ. EvoQ is under root 2 D by CH. Same parameters, same variables, and same formula is used here to understand how much cash has to be maintained. EvoQ inventory model used to establish the optimum cash investment policy. So, CO is equal to what is the transaction cost. CH is what is the cost of holding the inventory or cost of holding the cash here in cash management. D is what is the demand for cash during the period, over the period. So annually how much cash is needed. What is the cost of holding the cash, not investing anywhere. Holding the holding the cash is what is the opportunity cost on that. Then what is the transaction cost if they are investing, what is the transaction cost, that is brokerage commission paid, etc. Substitute these values to understand what is the requirement of cash. Another model is given by Miller and ORR. Miller ORR model, what we call it as. What does it say? It says that at any given point of time, what is the maximum amount of cash which is needed? The maximum limit should be understood. And the least requirement of cash at any given point of time is the minimum cash balance, which also has to be estimated. So the cash balance is between the minimum requirement and the maximum requirement. Okay. It should not fall below the minimum. If it falls below the minimum level, then it's a problem. They will not have funds available to meet the payment, reputation gets affected, etc. etc. So it should not go below the minimum level, and it should also not go above the maximum level. Above the maximum level, it is idle funds. They would not be helping the business in any way. Idle funds, no profit earned on those idle funds. So now what has to be looked into is a balance, or the amount of cash balance. It should be ensured that lies between, or it is between the minimum level and the maximum level. Fine. So the formula looks complicated, but don't have to be worried about that. The formula of Miller ORR model of cash management is given as uh, by these formula. But what does this model basically talks about? It says that, see, when there are when the cash balance is fluctuating, let's say that, so some amount of cash, now day in and day out they receive cash, they pay cash. So managing that cash, if they see that the balance of cash is exceeding more than the maximum level, when once it crosses beyond the maximum level, it becomes idle funds with no return on those idle funds. So once it touches the maximum limit, so whatever is the cash over and above the maximum amount is invested into some short-term investment, some securities, marketable securities, some way. See, it is diverted there. So at least it is a minimum return. Some return would be earned on that, ensuring that the cash balance does not cross beyond the maximum level. Fine. Then, in these fluctuations, when it touches the minimum, it should not be allowed to go below the minimum level. So once it is understood that it is going below the minimum level, whatever investments or current assets they have as marketable securities or some short term investments, they should be converted into cash to ensure that it rises above the minimum level. So in both the situations, we see the maximum limit and the minimum limit. They are ensuring that it reaches the return point. So what the return point? How do we decide on what is the return point? Is the return point is given by a formula which says that lower limit plus one third of the spread. But what is spread? Spread is 3 into 3/4 of transaction cost into variance of cash flows. The whole thing is divided by interest rate, and it has an exponential value. That's cube root of the entire formula. 3 into cube root of 3 by 4 into transaction cost into variance of cash flows divided by interest rate. Okay, it is useful for more erratic cash flows. So when there are many fluctuations in the cash balances, to ensure that it doesn't cross the maximum limit and getting converted into idle funds, to ensure that they are put to use. Once it reaches beyond the maximum point, those funds are taken, those cash balances are taken and invested into some securities. And once it goes below the minimum point, at that time, these securities are sold and effort is made to come back to their return point. So return point is given by equations. Just remember them and then apply them. That is cash management of ORR model. Would you like to try uh, some numerical questions?
Sure, ma'am.
Okay. Just give me a second. I will put the questions here on the Excel file, and then we can work out few numerical questions on working capital management. You are attending the class from college premises.
No, ma'am, I'm at my home right now.
Okay. One second. So this is question number 71 present here. A company has erratic daily cash movements with a standard deviation of 3000 per day. It costs $25 to move cash between its current account and its short-term deposit account. The deposit account earns an interest rate of 7.3% per annum. There are 365 days in a year. Calculate to the nearest thousands the spread between the upper and the lower limits that should be set for the current account using the Miller ORR cash management model. So let's take this one and okay, let's write the formula for okay. What is the formula for spread? Spread is equal to 3 into cube root of 3 3 by 4 into transaction cost into variance of cash flows divided by interest rate whole to the power of 1 by 3. So we need to define all these things. We need to know what is transaction cost, what is variance of these things have to be understood. So let's define them. So I'll put you to a file where I have done this one earlier. So you can look into this one, and then the transaction cost is given as $25 to move cash between. So that's the transaction cost. What is variance of cash flows? The standard deviation is given as 3000. So variance is standard deviation square. Standard deviation square will be 3000 into 3000. So it's given as 3000 to the power of 2. 3000 into 3000. Then interest rate is given as 7.3%. Fine. So what is interest rate per day is equal to this divided by, in a year there are 365 days. So interest rate per day is 0.0002. Fine. After that, calculate what is spread. So spread is equal to 3 into, so the cube root of, that is to the power of 1 by 3, cube root of, in bracket we have 3/4 into the transaction cost. So it's into the transaction cost into the variance of cash flows divided by the interest rate per day. Okay. So taken up, we calculate what is the spread. So the question is asking us find out what is spread between the upper and the lower limits that should be set for the current account using Miller ORR cash management model. Make a note of it.
Okay. Excuse me, ma'am.
Yeah.
Ma'am, I just talked to Bhavna ma'am and she told me that she'll be updating you. But,
Okay.
just a second, ma'am.
Yeah.
Ma'am, are you there?
Yeah.
Yeah, ma'am. She's saying that she's still dicey about, postponing the lectures to a
Okay.
later date because students are not joining in.
Okay.
And ma'am, I'm really sorry for the inconsistency because even if I join in for the lectures, I can't promise for the other students.
Okay. So what would happen?
Ma'am, I think that Bhavna ma'am will be able to, postpone it.
Okay.
Yeah, ma'am, you were talking about, clubbing our lectures
Hmm.
with other colleges. What
Yeah.
about it?
Yeah. So that, I think that it should be okay. So that
Yeah,
can
ma'am, no,
take.
no worries, ma'am.
You want to leave now?
Yes. No, ma'am, you can. We can study till 1 o'clock if we
Okay.
have.
Okay.
Ma'am, just a quick Do you know Sarvesh, sir?
Huh.
He's from ISGCS. Yes, ma'am, you can continue.
Yeah. Yeah. So we'll look at other questions also. Uh, the next topic is how is a cash budget prepared? I mean, see when cash is invested um, in various current assets. So during a period, for the future period, how much cash would be required also has to be assessed, because they also have to ensure that it doesn't go below the minimum limit, to ensure that they can make the payments promptly on the due date. So that is one important part there. So a cash budget is prepared. So basically, what do we have under cash budget? Cash budget says that um, for any period, understand what are the cash receipts which would be collected from the customers, either cash sales or credit sales made in the past. At the end of the credit period, they would be receiving. So during a period, what are the sources from which cash is collected? So the first thing is they have to understand what is the cash receipts. For preparation of a cash budget, the cash receipts are taken into consideration. Okay. And if there is any balance at the beginning of the period, that is the opening balance of cash. So opening balance plus the cash receipts from the customers, these two things are taken into consideration. Then they also would require cash amount for making their payments. Fine. So if we put cash receipts and cash payments, the difference between these two, if receipts are more than the payments, they would receive more amount of cash than what are their payments. So that is considered as a surplus. Or the other way around, we call that to be as deficit, surplus or deficit. So the opening balance is already there. Opening balance, now this is surplus or deficit, is the difference between the receipts, cash receipts minus cash payments. Then we also have the opening balance. So when opening balance is added to surplus or deficit, so opening balance plus surplus or deficit talks about the closing balance. Surplus or deficit talks about the closing balance. So this is equal to closing balance. What will happen to the closing balance? It will go to the next period as opening balance. This is all, this is the procedure. Fine, this is fine. But let's say that there is deficit, and will they just carry this deficit to the next period? Then next period also there will be an impact, because they start with a deficit and it will continue. And it should not be a deficit is what we have discussed. It should not be a deficit, because if they have less amount of cash available with them, they will not be able to make the payments promptly. Okay, so that is a risky situation. So when they understand that there is a deficit situation, then they think about raising some finance, short term finance, maybe go for an OD, or a short term loan or something is raised to ensure that they can make the payments promptly. If they see that there's a lot of surplus balance available, then they can think about investing this surplus in some source of finance. So at least they can earn some return on these finances which are invested. So for that reason, a cash budget has to be prepared. Cash budget is prepared periodically for the future period. So to ensure, to look into what are the requirements. So the various sources of cash are considered. The various payments which have to be made are also taken into account, to just understand whether the receipts are more than the payments or the other way around. If receipts are more than payments, then those surplus amounts are considered and added, and the opening balance is added to see that whether they have sufficient amount of cash. If they do not have, loans are raised or short-term sources of finance are raised, and to meet the deficit situation, or they can also think about investing in some investment opportunities. So that's a cash management cash budget problem. So there's one question earlier I have done with some other class. I will put that to you so that you can have a look at anyway time is over. We can look into that cash budget. There's a question given here. Sales before discounts for a company are predicted to be as first month till the sixth month. Predicted sales, forecasted sales are given to us. Then it says that 20% of the sales will be for cash, with customers taking a 2% discount. 40% of the sales will pay in the following month and 35% in 2 months. The remaining 5% will be written off as bad debts. Calculate the cash receipts for the month 3 to 6. So, for taking from third month to sixth month. The point here is when credit sales are made, the receipts from credit sales will be from the future. So it will be in the future. So the amounts will be collected in the future. So if we are talking about uh, a sale happening in uh, third month, payments receipts will be in the future months 4, 5, 6, depending on the terms of the credit policy. We are not talking about when it would be received. We are talking about how much would be received during a period. The question is how much, calculate the amount of cash receipts which will be received during periods 3 to 6. So to receive the amount, the sale should happen in the previous months, preceding months. If the sales happen, then out of those sales, the amounts will be received in the current month. The terms and conditions are, what are the terms? It says 20% of sales will be for cash. So whatever is the sale value, out of that, we can see that 20% is for cash. Cash sales will be received during the same month. After that, then they say that um, with customers taking 2% discount and 40% of sales will pay in the following month. So next percentage is 40%. 40% of sales. But when will the cash be received? The cash will be received in the next month. Then another percentage is 35%. 35% 2 months later. 35% of the sales 2 months. The month following the next month. So 2 months later it will be received. 5% is bad debts. It will not be collected at all. Fine. It says that calculate what are the cash receipts. So if we have to talk about cash receipts, let's say the sale of third month, because we are asked to calculate it from 3 to sixth month. Okay. Third month sale, how much is third month sale? 58. Okay. So out of 58, only 20% of the amount will be collected in the same month. But they will also be availing a discount of 2%. Do you see that? They also will avail a discount of 2%. 20% of that will be collected during the same month. So the 58, so you see that in the formula bar, 58 into 20%. 20% will be collected in the same month. Third month only it will be collected. But after a discount, so only 98% of the amount will be collected. Okay. Then next month, how much will be collected? 40%. So if it is 40% in the next month, you see that in the next month, 58 into 40%. 2 months later, the balance of 35%. Okay, so I have colored it for each month, one color. So we've used it to understand that what happened to this particular thing. Then come to fourth month. Fourth month also, so we see fourth month 63 into 20% into 98%. That will be the collection during fourth month. But during fifth month, 63 into 40%. During the sixth month, it will 2 months later. That is the meaning. 2 months later, we see 63 into 35%. Similarly for fifth month, sixth month also. Okay. But what about the previous months also sales were made, and those sales also will be collected during these months. So second month sales, 20% in second month, 40% in the third month. So we start with this one. So second month sales are 55, 55 into 40%. Then 55 into 35%. Okay. So first month also, first month 20% in first month, 35%, 40% in the second month, 35% in the third month. So third month is also would also receive an amount from first month sales. So 50, I think I wrote it wrong here. It should be 50 because first month sales are only 50. So 50 into. So then what are the cash collections? Just add them up. Add all these figures and then you would get what are the total cash receipts for the months from 3 to 6. Do you see that? To make it clearer, I just colored it with a particular color for one particular month sales. Is that clear?
Yes, ma'am.
So study well for your exam.
Yes, yeah, sure, ma'am.